Hello, and thank you for joining us. My name is Angela Ost. I am the Director of Planned Giving at Cornerstone Advisors, and joining me is my colleague Steve Link, Cornerstone's Director of Philanthropic Services. Today, we're going to discuss the topic of philanthropy and tax planning. But before we jump in here, I just want to remind everyone that we are not here to offer any type of tax or legal advice. So please refer to your advisor team for any questions on this topic. So, Steve, it is October again. What should the philanthropically minded individual be thinking about as we approach the end of the tax year here?
Well, I don't know about you, Angela, but I'm finding the distance between October and December 31st gets shorter and shorter with each passing year.
It
Um,
does.
so this is an ideal time to be looking at your philanthropic planning and your assets to determine what method of giving has the greatest impact, both personally and philanthropically. And in my mind, there are three key considerations to this. First is timing of the gift and the use. Second are the best assets to consider giving. And the third is the income and whether you are going to need the income from the assets you're giving away and what some alternatives might be.
Can you elaborate a little bit more, Steve?
Sure. So if you want a tax deduction this year, it's critical to start planning now because the gap between now and the cutoff is rapidly approaching. Are you planning to bundle giving this year to maximize your deduction and then take the standard deduction next year? Are there other considerations you should be thinking about? These are good questions to talk about with your tax accountant. For those who are under age 70 and a half, you may want to consider giving stock that has run up in value. This is a great option to thin a stock holding that has potentially become disproportionate to your other holdings, or a stock that you're concerned is going to drop significantly in a softening stock market should that happen. In either case, you may give the shares directly to charity if they can accept stock, or you can put them into a donor advised fund and then distribute those funds, not just in the current year from the donor advised fund, but carry those forward in future years. As with gifts of appreciated security, you can deduct them up to 30% of your adjusted gross income. And to the extent that you can't fully utilize that deduction this tax year, you can carry that tax deduction forward for up to 5 additional tax years.
Okay, and then what about for those individuals who are over the age of 70 and a half?
So there are some benefits to being a little bit older. And if you're 70 and a half and have a tax deferred retirement plan, you may give up to $105,000 from your tax deferred plan directly to charity as a qualified charitable distribution. The beauty of this is that distribution doesn't increase your adjusted gross income. On the other hand, it's not a tax deductible gift because you never paid tax on the dollars going into that plan. Some great aspects of this are that you can have an immediate impact on the charity that's important to you. And if you're required to take a minimum distribution, these QCD contributions count toward your required minimum distribution.
Okay, but what if we have somebody that would prefer or just needs the income? What options do they have?
Sure. There are some other vehicles that are out there, charitable vehicles that will either pay a fixed income stream, such as a charitable gift annuity, or a variable stream of payments, typically coming from a charitable remainder unit trust. These are both options that will give you a partial charitable deduction for the face value of what you're putting in, and then you retain the income stream for the balance of your life or whomever you designated as the beneficiary, with the remainder going to charity either when you terminate that payment stream or you pass.
And who should viewers really be connecting with to explore these options?
Well, as you said in the beginning, Angela, first and foremost, we encourage you to sit down with your professional advisors and be completely transparent with them in terms of the types of assets you have so that they can give you good counsel in what are the best assets to consider for contributions. Next, we encourage you to reach out to the charities that are important to you and make sure that they are in a position to receive the type of gift that you would like to make. It's always better to have the conversation up front and then modify your plans if necessary. Last but not least, we strongly encourage you to get started now And while October may see months away from December 31st, most tax deferred retirement plan administrators have a December 1st cutoff for making or committing to make the distributions from your account for charitable purposes. And unlike gifts of checks or of stock, this has to be out of your account and to the charity by 12/31. This is not something that can have simply a postmark date on it.
Great. Well, thank you, Steve, so much for all of your insight. Thank you to everybody for joining us in another conversation in philanthropy. In the interim, please reach out to us if you have any questions or if there's anything that we can help you out with. Thank you.